Every time you hear that mortgage rates go up, your first thought is probably the Federal Reserve. But that's only part of the story. The number that quietly decides how much your house costs, how much your retirement earns, and even whether your employer finds it cheap enough to borrow money and keep hiring people, is the bond market. Most Americans never look at it, yet it reaches into almost every financial decision they make. Hey, I'm Brian, and I spend way too much time thinking about why money seems to get more expensive even when nothing about your paycheck changes. The answer almost always leads back to bonds. If you don't understand bonds, you don't understand why borrowing becomes expensive, why savings suddenly pay more, why retirement accounts sometimes lose money when they're supposed to be safe, or why the economy speeds up and slows down. By the end of this video, you'll understand the system that quietly prices nearly every dollar in your financial life. And if this is the kind of clear financial breakdown you enjoy, consider subscribing, because we unpack topics like this every week. At its core, a bond is simple. It is a loan. One side lends money. The other side promises to pay interest every year and then return the original amount on a specific date. That annual interest payment is called the coupon. The day the original money comes back is called the maturity date. Everything else people say about bonds grows out of those three ideas. Now scale that up. Instead of lending money to your neighbor, imagine lending money to the United States government. Millions of investors do exactly that every day by buying United States Treasury securities. Pension funds buy them. Banks buy them. Insurance companies buy them. Foreign governments buy them. The United States Treasury market alone is worth tens of trillions of dollars, making it one of the largest and most important financial markets on Earth. Around the world, the bond market is even larger than the stock market. It is the plumbing of the financial system. When money moves through the economy, bonds usually determine the price. That matters because every other loan begins with the bond market. Banks do not wake up every morning and randomly decide mortgage rates or business loan rates. They begin with government bond yields and then add extra interest to compensate for additional risk. If government borrowing becomes more expensive, almost every other type of borrowing becomes more expensive too. Before anything else makes sense, there is one rule you must remember. When interest rates rise, the price of existing bonds falls. Say it again. When interest rates rise, the price of existing bonds falls. The opposite is also true. When interest rates fall, the price of existing bonds rises. These two always move in opposite directions. Here's why. Imagine you buy a bond today that pays 4% every year. Next year, newly issued bonds suddenly pay 5% because interest rates increase. If you try to sell your 4% bond, nobody pays full price because they can buy a brand new 5% bond instead. Your older bond has to become cheaper before another investor is willing to buy it. Its price falls until its return becomes competitive again. Now reverse the situation. Suppose you own a 5% bond, and new bonds suddenly pay only 3%. Your bond becomes more valuable because it pays more than newly issued bonds. Investors compete to buy it, and its price rises. Nothing mysterious happens. The payments stay exactly the same. Only the market price changes. Once you understand that one relationship, almost everything else in the financial system starts making sense. That rule also explains something far more personal. Your mortgage payment. If you're new here and just subscribed, comment your name below. I read every comment and shout out new subscribers in my next video. I do appreciate you joining me on this finance journey. Meet James. James is 34 years old. He earns a steady income, has saved for a down payment, and wants to buy a home priced at $400,000. He puts down 20%, leaving a mortgage of $320,000. James thinks his biggest challenge is saving enough money. It isn't. The bond market has already decided whether this purchase feels manageable or painful. Banks typically look at the 10-year United States Treasury yield as the starting point for pricing a 30-year fixed mortgage. They then add roughly 2 percentage points because lending to a homeowner carries more risk than lending to the United States government. Today, with the 10-year United States Treasury yielding around 4.5%, the national average 30-year fixed mortgage rate sits around 6.5%. On James's $320,000 mortgage, that means a monthly principal and interest payment of roughly $2,023. Now change only one number. Suppose bond yields rise by just 1 percentage point, pushing mortgage rates to roughly 7.5%. James's monthly payment jumps to about $2,238. That is an increase of roughly $215 every month. Over 1 year, James pays about $2,580 more. Across the life of a 30-year mortgage, that single percentage point costs him roughly $77,000 in additional payments. Nothing about James changes. His income stays the same. The house stays the same. The neighborhood stays the same. Only bond yields move. Now look at history. During early 2021, 30-year mortgage rates briefly fell below 3%. A buyer financing the same $320,000 loan paid around $1,349 per month. By late 2023, national mortgage rates climbed above 7.75%. That same loan cost roughly $2,290 every month. The difference approaches $1,000 every month. Across 30 years, the additional cost reaches hundreds of thousands of dollars. Most buyers believe they are negotiating with a bank. In reality, they are negotiating with the bond market. If changing bond yields can reshape one family's mortgage, imagine what happens when rates move across the entire financial system. That is exactly what happens in 2022. The Bloomberg United States Aggregate Bond Index, which tracks the broad United States investment-grade bond market, falls about 13% during the calendar year. It is the worst annual performance in the index's history, which stretches back to 1976. Many retirees believe the bond portion of their portfolio exists to protect them when markets become volatile. Instead, the protection disappears. The traditional 60% stock and 40% bond portfolio loses roughly 16% during 2022 because both stocks and bonds decline together. Millions of investors discover that the asset they considered safe still carries risk. The reason has a name: duration. Duration measures how sensitive a bond or bond fund is to changes in interest rates. In simple terms, it estimates how much the price changes when interest rates move by 1 percentage point. Imagine two investors. Sarah invests $500,000 in a bond fund with a duration of 6. David invests the same $500,000 in a different bond fund with a duration of 17. Interest rates rise by 1 percentage point. Sarah's investment falls by roughly 6%, about $30,000. David's investment falls by roughly 17%, about $85,000. The difference is $55,000. They invest the same amount of money. They both own bond funds. The only difference is duration. Most people who lose money during periods of rising interest rates never know this number exists. Yet it quietly determines how much of their retirement disappears when yields move higher. Once you understand duration, the next question becomes simple. If the bond market is powerful enough to change mortgage payments and retirement balances, does it also give us clues about where the economy is heading? It does. One of the most closely watched signals is called the yield curve. The yield curve compares interest rates on United States Treasury securities with different maturities, from a 3-month Treasury bill all the way to a 30-year Treasury bond. Most of the time, longer-term bonds pay higher yields because investors expect more compensation for lending money over a longer period. Occasionally, that relationship flips. Short-term Treasury yields move above long-term Treasury yields. That is called an inverted yield curve. The bond market is effectively saying that investors expect the Federal Reserve to lower interest rates in the future because economic growth is likely to weaken. Investors rush to lock in today's longer-term yields before those future rate cuts arrive, pushing long-term yields lower. This is not just a theory. Research from the Federal Reserve Bank of San Francisco finds that every one of the last 10 United States recessions since 1955 is preceded by an inverted yield curve. 10 recessions, 10 inversions. That gives the signal a perfect record across roughly 70 years of economic history. No indicator predicts the exact month a recession begins, and none guarantee the future will perfectly match the past. But very few public financial signals have a record this consistent. The remarkable part is that anyone can monitor it for free. The United States Treasury publishes Treasury yields every business day. Financial news websites update them in real time. There is no subscription. There is no special software. Yet most retail investors never look at the market that professional investors often check before they open a stock chart. That signal also feeds directly into the next step of the chain: the prices of stocks, business investment, and ultimately the job market. Imagine a company wants to build a new factory that costs $100 million. It has two choices. It can borrow money through the bond market, or it can raise money by selling stock. When Treasury yields rise, borrowing becomes more expensive because investors demand higher returns from almost every borrower, not just the United States government. Corporate bond yields increase. Business loans become more expensive. Credit becomes harder to obtain. That difference between the yield on a United States Treasury security and the yield on a corporate bond is called a credit spread. A wider credit spread means investors believe companies are becoming riskier, so they demand more compensation before lending money. Higher borrowing costs often lead companies to delay expansion. Delayed expansion can mean fewer construction projects, fewer equipment purchases, fewer new offices, and fewer employees hired. The same rise in bond yields also changes how investors value stocks. Every investment competes for the same dollar. If a relatively safe Treasury security suddenly offers a much higher return, investors expect an even higher return from stocks to justify taking additional risk. That relationship is known as the equity risk premium. As required returns increase, stock valuations often fall, even if the companies themselves continue earning profits. The chain is remarkably direct. Higher Treasury yields lead to higher borrowing costs. Higher borrowing costs slow business investment. Slower investment weakens hiring. Weaker hiring slows consumer spending. Slower spending affects corporate earnings. And changing expectations about those earnings feed back into stock prices. What begins as a movement in the bond market eventually reaches paychecks, retirement accounts, and the broader economy. Which brings us back to James. James cannot control bond yields, but he can stop ignoring them. Before applying for a mortgage, refinancing a loan, or moving money into a bond fund, James spends 2 minutes checking the current 10-year United States Treasury yield. That single number tells him whether borrowing costs across the economy are generally becoming cheaper or more expensive. He also looks at where his cash is sitting. According to the Federal Deposit Insurance Corporation, the national average savings account pays around 0.38%. At the same time, 3-month United States Treasury bills yield around 3.71%, while many high-yield savings accounts pay roughly 4.20%. For emergency savings, that difference matters. A person keeping $50,000 in an average savings account earns roughly $190 per year before taxes. The same amount earning 4.20% generates about $2,100 per year. That is a difference of roughly $1,910 without taking meaningfully more risk. There is another advantage many people overlook. Interest earned from United States Treasury bills is exempt from state and local income taxes, making them even more attractive for many investors than their headline yield suggests. If you remember only one number from this video, make it the 10-year United States Treasury yield. It quietly tells you where the cost of money is moving, and that affects far more than the bond market. At the beginning of this video, I said the bond market quietly decides more about your financial life than most people realize. Now you can see why. Your mortgage, your savings account, your retirement portfolio, business hiring, stock valuations, and even recession warnings all begin with the price of money, and the bond market helps set that price every single day. Bonds are not something rich people do. They are the invisible system that already governs your financial life. The people who understand that system are not smarter than everyone else. They simply stop looking away. If you found this breakdown useful, leave a like and consider subscribing. Thanks for watching, and I'll see you in the next one.